The U.S. has launched a military strike on Iran. Markets are rattled. Oil prices are spiking. Investors are worried. Is this the start of a market crash? Let's look at what history tells us and why smart investors don't panic. Every time war headlines hit, the market reacts. In the hours after the strike, we saw a sharp drop in global equities and a surge in oil prices as Iran threatens to close the Strait of Hormuz, where nearly 20% of global oil passes through. Volatility is back. Fear is high. But here's the truth. Geopolitical shocks don't usually lead to lasting market damage. Let's go back in time. 2003, Iraq War. Markets dropped before the invasion, then rallied nearly 15% within 3 months. 2001, 9/11 attacks. Markets closed for a week. When they reopened, the S&P 500 fell 12%, but fully recovered in just 30 trading days. 2022, Russia invades Ukraine. Oil spiked. Markets dipped. But the S&P 500 was back up within weeks. Fact. According to LPL research, the average market recovery after a geopolitical crisis takes just 47 days. Iran is different, but not unprecedented. If Iran closes the Strait of Hormuz, it could push oil prices over $100 per barrel. This may hurt transportation, airlines, and global supply chains. But remember, the U.S. is now the world's largest oil producer. We're less dependent on Middle East oil than ever before. Markets may wobble, but unless this escalates into a full-scale war, history says the recovery will be swift. Fear-based selling destroys portfolios. Staying invested builds wealth. During every war, some sectors fall, but others thrive. Defense stocks go up. Energy companies profit. Gold and treasuries spike. Long-term investors know this. Markets price in war quickly, then shift back to fundamentals. This strike on Iran is serious, but it's not the end of the market. It's just another shock in a long line of shocks. So what should you do? Don't panic. Stay diversified. Zoom out. Over the past 100 years, the S&P 500 has returned 10% annually through wars, recessions, and political turmoil. So breathe. Stay calm. And remember, time in the market always beats timing the market. Like this video. Subscribe for real-time market insights backed by history, not headlines.